All right, let's jump right in. Welcome back to The Explainer. Today we are looking at an absolute giant. We're talking about the Walt Disney Company. As of late April 2026, Disney is battling right at the intersection of the physical and digital economies, and it's a fascinating case study. We're going to break down this entertainment behemoth using a structured, top-down analysis. We're looking strictly at the data, the charts, and the strategy to see exactly what's driving the stock right now.
Here is our roadmap for today. We'll hit the 2026 market landscape, check out some regulatory headlines, dive into their financial health, look at the technical charts, and wrap it all up with investment strategy. Let's get to it. Section 1, the 2026 market landscape. A market divided. So look, right now we're seeing this crazy contrast in where capital is flowing. On one side, you've got the broader market, especially the Magnificent Seven, just completely obsessed with artificial intelligence capital expenditures. I mean, tech giants are pouring literally billions into cloud and AI. But then, there's Disney. Disney has this totally unique setup. They have these tangible, physical theme parks that, let's face it, an AI just can't replicate. And they combine that with a massive digital streaming ecosystem. In a market chasing the AI hype, Disney is essentially the ultimate physical meets digital value proposition. But hey, the broader macro picture, it is definitely not all smooth sailing. Brent crude just surged past $103 a barrel, hitting a 4-year high. That kind of jump really highlights the sticky inflation risks we're dealing with, and it's making a Fed rate cut look pretty unlikely anytime soon. This macro headwind is exactly why investors are being so incredibly cautious with their capital right now. They're demanding real, actual profitability today, not just promises of growth 10 years down the line. Moving on to Section 2, headlines and regulatory risks. The noise versus the signal. Okay, so with a behemoth like Disney, we have got to separate the short-term noise from the long-term signal. And man, there is a lot of noise right now. Take a look at the timeline on this highly unusual regulatory move. The FCC recently ordered an accelerated review of Disney's local ABC broadcast licenses. Originally, these renewals weren't even on the calendar until somewhere between 2028 and 2031. But in late April 2026, the FCC suddenly demanded an early review. They cited an investigation into Disney's diversity, equity, and inclusion policies, which, as you probably know, surfaced during those very public political back and forths between Donald Trump and Jimmy Kimmel. Because of that, Disney is now staring down a super unusual accelerated deadline of May 28, 2026, just to apply for their renewals. So, what does this political clash actually mean for the stock? Well, it creates what we call an uncertainty discount. Basically, that's just a drop in the stock's price because of unpredictable regulatory drama. Now, broadcast stations do have to operate in the public interest, but the FCC actually revoking a license? That is incredibly rare. We're talking something that hasn't happened in 40 years. Still, the legal costs and just the scary headlines alone, yeah, they're enough to put some temporary downward pressure on the stock. For their part, Disney is absolutely not backing down. Their official statement says, and I quote, ABC and its stations have strictly complied with FCC regulations and are prepared to fight strongly through legal channels. Basically, they are treating this as a straightforward legal battle, and as investors, we really need to view this as a short-term headline risk, not some fundamental crack in their core business model. And speaking of those core fundamentals, let's pivot to a really massive strategic signal. For the longest time, Wall Street was practically begging Disney to spin off ESPN. Well, scratch that, it's officially canceled. Disney decided to keep ESPN in-house and integrate it directly into their Disney Plus and Hulu ecosystem. It's a huge bet. They're banking on live sports being the ultimate anchor to keep subscribers glued to their direct-to-consumer bundle. All right, Section 3, financial health and earnings. Let's look beneath the surface. Let's dig into the hard numbers from the first quarter of fiscal 2026. Total revenue bumped up 5% to just under $26 billion. Now, you might glance at that operating cash flow line, down a staggering 77% to $0.74 billion, and completely panic. But context is everything here. That drop is mostly just a temporary $1.7 billion deferred tax payment, plus some massive capital expenditures to upgrade the theme parks. The real star of the show is down at the bottom. Streaming operating income actually flipped to a positive $450 million. That is a gigantic $189 million swing in the right direction. To really get why this matters, we have to talk about free cash flow margin. That just measures a company's ability to turn sales into actual usable cash after paying for all those big capital investments. Yes, Disney's Q1 cash flow took a temporary hit because they're aggressively plowing $3 billion right back into the parks. But listen to this. Their long-term guidance of generating $19 billion in operating cash flow, that remains totally intact. And that mountain of cash is exactly what's funding their massive $7 billion share buyback program. It's super important to understand how these different segments balance each other out. Their experiences division, which is the parks and the cruise lines, is just an absolute cash cow. We're talking $10 billion in revenue and $3.3 billion in operating income in Q1 alone. It proves they have incredible pricing power. Meanwhile, the entertainment and sports segments, that's where all the digital transition heavy lifting is happening. And that entire digital transition really hinges on operating margin. That's simply the percentage of revenue left over after you pay variable costs. Look, for years, Disney's streaming business was just burning a hole in their pocket, creating this huge negative drag on the stock. But now that their streaming margin has shifted from the red into a positive $450 million profit, it essentially removes the biggest discount on the stock. This is exactly the kind of trigger analysts look for to upgrade a company's valuation multiple. So, looking ahead to the Q2 2026 earnings report dropping on May 6th, the vibes are pretty optimistic. Consensus is expecting earnings per share to hit $1.49, which is up nearly 3% year over year. Plus, they're looking for streaming profits to climb even higher, hitting that $500 million mark. Disney has actually beaten EPS estimates for the last 4 quarters straight. So, if they deliver a massive positive earnings surprise here, that could honestly be the ultimate catalyst for a huge breakout. Which brings us to Section 4, Technical Analysis and Charts, Reading the Tape. Okay, we've got the fundamentals down. Now let's read the tape and see what market psychology is telling us. Right now, Disney's stock is caught in a classic wait-and-see holding pattern right before earnings, hovering around that $101 to $102 mark. It's battling right on its 20-day and 50-day moving averages. The RSI, or Relative Strength Index, is sitting squarely in neutral territory between 40 and 49, so it's not overbought, not oversold. The MACD indicator is showing a nice little bit of positive upward momentum, and if things go south, downside risk is currently protected by a really strong support zone sitting between $91.50 and $93.30. But if we're looking to the upside, this is the magic number you've got to watch, $107 to $110. This specific range acts as the 200-day moving average resistance line. It's the ceiling. If Disney can drop some stellar earnings and smash through that $107 to $110 ceiling with high trading volume, technical analysts are going to view that as the ultimate confirmation of a true long-term bullish reversal. Finally, let's wrap it up with Section 5, Investment Strategy and Targets. Putting it all together. How do we actually turn all this data into a game plan? Well, let's look at what the pros are saying. The base case consensus puts the price target at $133.53, assuming a standard price-to-earnings ratio of 19x. Goldman Sachs is leading the bull case with a really aggressive $151 target. They are betting big that streaming margins will hit 15% and that those park expansions are going to pay off fast. Now, even the bear case, which assumes legacy TV just tanks and high oil prices trigger a recession that keeps people out of the parks, even that bear case sits at $115. Notice how even the worst-case scenario target is still significantly higher than the current $101 trading price. Pretty interesting. If you're actually trading this, analysts suggest using a structured framework. Step 1. Consider an initial 50% entry right here, around the $100 to $102 level, just because it's so close to that $92 support floor we talked about. Step 2. Wait for those May 6th earnings. If the numbers are fantastic and push the price past that critical $107 resistance, then you add the remaining position. And step 3. Always manage your risk. Think about taking partial profits once the stock hits that first major resistance zone around $115 to $118. And of course, no solid strategy is complete without a safety net. $88 to $90. That is your absolute stop-loss floor. If the stock falls below that level, maybe those FCC regulatory headaches turn into a harsh reality, then the whole technical and fundamental thesis we just built today, yeah, it's considered broken. At that point, it would be time to drastically reduce your exposure. So we've covered the macro landscape, we've separated the regulatory noise from the real streaming profits, and we've mapped out the technical charts. Disney is clearly at a massive turning point right now. So the question I'll leave you with today is this. Does Disney's transition from an old-school legacy value play into a modern streaming growth story make it a compelling thesis for your own portfolio? Take these educational lessons, apply them to your own research, and keep digging. Thanks so much for joining me on this explainer, and I will catch you in the next one.